if the rules to the game have been rewritten, then I want you to know first, and I want us to be able to make strategic decisions based on the new rules. And so, I want to tell you a quick story about why this is on my mind. I was at my mastermind group recently, and I was with a number of large real estate investors. We're chatting, investors and developers, and one of them from the U.S. said, I'm starting to think Canadian real estate just might never come back. And we kind of, it was like almost like a joke a little bit, because we've always just believed in real estate. But I got to thinking about it, and I'm like, you know what? Let me think about that for a few minutes. We started to talk about Japan, and since the late 90s, early 2000s, Japan's economy has not come back. And it's been 25 years, and they have been stagnated for 25 years. Now, I don't want to get into the macroeconomics of how that may or may not be a comparison, but my point is, holy shit, maybe it can happen where real estate does stagnate. Is real estate too big to fail? And so I'm really leaning into this idea. We are doing the research around the history. We are talking to experts like the conversation we're going to have today. And I was challenging the assumption of real estate being too big to fail. And I came up with this insight that confidence isn't the same as confirmation. Just because Canadian real estate has always rebounded, and I've been confident in that, isn't confirmation that it will always happen. And I want us to talk about that today in terms of what are the rules of the game going forward. I simplified my thinking into three main buckets. Is we are either in a rebound. This is a classic comeback that by later this year or early next year, we are back to the numbers that we've always seen as real estate investors. We could be number two into a grind, a slow, uncertain climb, a grind back to what we call real estate normal. Or we could be in a complete stall, a Japan style flatline for decades. So when I bring Sasha here on board, a man that needs no introduction, Sasha is the CEO of Greybrook Securities. I wrote down a couple things that I wanted to tell you about. Those of you that don't know him, he's been completely critical in bringing Greybrook's portfolio to over 110 projects, over $40 billion of completion value, all throughout Canada and the United States. I wrote this down around Sasha sits and has always sat at the intersection of strategy, execution, and market timing for 15, 20 years now. And I think he's the perfect guy to ask the question. The first question I have, Sasha, for you is, where do you think we are right now in these three buckets: the rebound, the slow grind, or the multi-decade stall? Where are we sitting in Canadian real estate right now? And then we'll get to the US. So Sasha, welcome to Inner Circle Live with one of the hardest questions I think I've ever asked.
I was gonna say, like you're not one to ease people into the discussion, just get right to the heavy stuff.
Let's get it. You know
Uh,
what? But I'm gonna say maybe this is because of our pre-show comments. Sasha asked me in our pre-show, he's like, "Do you have what did you say? Do you have a goatee?" And I said, "No, my beard is just grayed out, and you can't see the freaking hair." And then he said, "Hey, don't worry, man. I'm feeling it too." So we're we're
yeah,
all getting there, but there it
we
is.
are
It's no
all.
goatee. It's a real beard that is actually nice and gray, Santa Claus style.
Well, it's nice and dark up top where, I can't say the same for what's going on over here on this end of the camera, but yeah, like you said, I mean, we'll all get there at some point. So we'll take it as it comes, which is kind of, been my philosophy, to get to your question, in a maybe not a direct way, but somewhat direct way. My philosophy has been take it as it comes because I think in my job, and probably like your job, and people that are sort of at the CEO level, or they're sort of running a big business or big portfolio, you're a bit of a control freak, whether you want to be or not, right? Like you try to control all the variables, and you try to be on top of it all, and then you realize that there's stuff that happens that just you can't control no matter what. So then you have to shift your focus to the things that you can control, and where you should be spending your time productively. And the market, it just isn't one of those things. Like you can't will sales, you can't will economic recovery or prosperity or policy clarity or any of those things. Like, I mean, just that they're all outside of the realm of what we can do. So then you have to adjust your strategy to work within the reality that you have, and how do you make that work well? And I guess as to where we're at, I don't think we're in a recovery, but I also don't think it's going to be Japan. Economically speaking, I don't think our housing market is gonna take that kind of 30-year purgatory type thing. And for me, the real reason is that the components that make up our real estate market are for residential, and I think it's different for different things, right? Like we're Michael, you're a residential expert. I'm more of a residential expert. Like if we were sitting here talking about office or something else, I think there's been some systemic changes in how office is going to work going forward. I don't think residential has those same dynamics. Like, I mean, people need at the most simplistic level, like people need places to live, and there's more and more people. And in places like Canada and certain US markets, there's just an inability to create enough supply for those people to live, right? So I think there will always be a demand. I think that that demand will come back. I think what we're dealing with and grappling with here is, markets lost confidence. That's a big factor, right? Like if you're buying a house, whether you're an investor or an end user, somebody who just needs a house, you still want to make good financial investments, right? And when you're thinking about buying that house, you're worried right now because you're looking at the market, you're reading the headlines, and you're saying, man, is it going to get worse? So that's one thing, is the psychology that's in the market right now, and that has to change. The second thing is just the straight reality of affordability, right? And the components of that are, people's means, people's savings, and interest rates, right? Because obviously we all access, mortgages for the most part to be able to buy. So something has to change in that equation, right? And I think the most likely is going to be, mortgage rates over time. So for those reasons, I think, I don't think we're in a recovery. And so grind, like, do I want to call it a grind? Let me answer the question from my perspective. I think it's going to be a grind for a while. And then I do think we're going to see a rebound. So we'll go from the second bucket you described, in my opinion, to the first. And the reason we move to that first is because that supply-demand dynamic, that scarcity that exists, is real, and it's only getting worse, right? So if you're in Southern Ontario today, a place that needs a lot of housing, nothing's being sold, nothing's being built, and it's only compounding a future problem. And I believe that, we're going to see that manifest, but it's going to take time. Like, this is not a today or tomorrow solution, in my opinion.
Yeah, that was going to be my where I wanted to go with it, is what I'm thinking is, well, okay, well, how do we move between levels? Whenever we're thinking about something in different levels of being ideal, how do we move from the grind? And I agree with you. I feel like we're not going to be, Japan is totally different. They have no natural resources, at scale. They don't have a whole number of things that we have in Canada, and certainly what the US has. But the US is a different market than Canada. So just to speak to Canada, we've got resources, we've got all kinds of things on our side. So I don't think we've got a long-term stall, but I don't think it's a rebound. We met on March 11th, Sasha, and we had some maybe more optimistic outlook of where we'd be here by July 23rd is where we're at right now. And we're not there. So it's kind of indicating to me we are in sort of that slow grind. And I was going to ask you, what is it going to take to get from a slow grind to a rebound? And so you're saying it's a supply and demand function. We look at supply and demand primarily.
Yeah, I think long term. So I want to address the first thing you said, which is,
Okay.
Japan. One of the things in Japan, obviously, is demographic, right? Like, I mean, you have a population that was kind of aging out. When you have an aging population, you typically have higher costs, right? Healthcare, social programs, and things like that, right? In an aging population, and they weren't replacing that younger working age population. That was one of the reasons that Japan's had some of the challenges with growth. I'm not Canada. It's not impossible that Canada finds itself there if we don't get our act together, right? So like, I don't want to just take for granted because we have resources, because we have different things. We also have overregulation. We also have a lot of different things that are hampering our ability to grow. If you think about, look, we're all real estate investors, but if you think about where a lot of capital has gone over the course of the last decade or two, it's gone into, real estate construction and the like, more than it's gone into productive industries like technology and manufacturing and innovation and things like that. So I think that equation has to change a little bit. The good news for Canada is, notwithstanding we're turning down our immigration targets, rightfully, given sort of this spike that we probably should never have had. So really, I don't see it as turning down our immigration targets. I see it as smoothing out over a longer period of time. But we have an openness to immigration, and that's critical to our economic growth because we are also, the baby boomers are getting into their retirement years, and work stops and costs increase. So we need to refill the population with working age people, and we do that through immigration primarily. So I think we will see a different outcome than Japan.
Yeah.
As to what, your question about what it takes, the supply demand to me is not the trigger. It's just the reality. Like the backdrop is that you have this, scarcity of housing. Okay. And that's been well narrated over the course of time. But the trigger is that you have to close the gap between what somebody can pay and what somebody needs to sell for. And me as a developer and investor in development, we have realities associated with that, right? You have, land costs you, your hard costs, your municipal fees, your taxes, and all these things. Okay. So the reason you're not seeing the market just drop, like, so people should be asking, well, Sasha, if there's all this demand and all this need for housing, like, why aren't people buying it? Well, because there's a standoff between what somebody can sell it for in the new construction area and what somebody can pay for it. There's a gap. And if it was as simple as just dropping your price and meeting that gap, sure, you'd sell a whole bunch of homes. But the reality is you can't do that because the cost structure, it's not greed, it's not wanting to make more profit, it's the cost structure is just prohibitive to that. So I think there's going to be, the trigger here is going to be a combination of improving affordability vis-a-vis growth in savings rates over time, but also interest rates coming down, right? Mortgages being more accessible, and the cost side of the equation starting to move down. And that, the industry's in constant dialogue with different levels of government, because that's your first lever. And hopefully there's no
Yeah.
government officials on this call, because I don't want to affect our negotiations. But we can't control the price of lumber because that's not in our control. That's like the universe of people who buy lumber, right? And it's not just residential housing, it's all different industries and all different things, and tariffs, and these things all affect the price of that input. Labor, right? That usually doesn't go backwards, right? There's unions, there's different things. It's not like all of a sudden, hey guys, prices have dropped, so Michael, we're going to cut your earning this year from 75,000 to 50. Well, that's not how it works, right? But what is fungible to a degree is that tax slash fee slash government layer. There are other ways that they could potentially finance some of the things. There's American members on this call. Lots of US markets don't charge development charges to the same degree that places like Toronto and others do. They fund their infrastructure vis-a-vis municipal bonds, right? So they go to the bond market, right? They have a credit rating, they raise money, they use those municipal bonds, and they fund their infrastructure. So there's different alternatives we can consider. And I think that the trigger point is going to be a combination of affordability with price, like I said, and then that cost structure coming down. And then as that comes to a more sort of reasonable level based on these two sides, the market will then find its footing. and then confidence starts to return to the market and more participants enter the market, both buyers and sellers. And that's what happens in these things. And we haven't seen a downturn as deep as this for many, many years, certainly predating my career in this industry, but we have seen it, right? We saw it in the financial crisis. We saw it again in 2011 and 12. You know, there were different drivers back then. It wasn't like an economic calamity. It was more policy oriented. 2017 with the fair housing plan and foreign buyer taxes and all these things, we saw a downturn. But this is how these things typically play out. The question is, how much time does it take for it to play out?
Yeah. Yeah, that's where we're in that, you're saying we're in that grind scenario, that middle grind scenario, because there's so many different things that need to happen that I agree will happen, but we've got to have the, it's slightly political, it's slightly economic. And, funny story, you talk about the cost structure. I was just in a situation where I was watching a municipality say, we are going to, instead of we're going to raise property taxes and taxes within the municipality to pay for our stuff, we're going to raise development fees. And developers are saying, guys, wait a minute, this is a direct pass through to the customer. You can't say our citizens can't afford to buy a property at the same time say that, hey, we're going to raise development fees in order to, raise money to give you what you want. And it might be just a miseducation of the general population of, when you raise development fees, you're not just, getting these rich developers and these CEOs and all of this, people are thinking someone else is taking the hit. That's a cost structure, because those properties are owned by investors, and that is passed right on to the buyer, and that keeps housing prices too high. And there's a lot of layers of cost, but in particular, the development fees, I've seen that a lot, where the citizens of a municipality are like, great, raise the development fees, but also help us buy a house. Like, these two things don't live in the same world.
Yeah, so that's it. It's very interesting, the point you're making, and I think it's an excellent point. And I go to dark places when it comes to this type of discussion, because, if you're a counselor in a certain ward and you have a choice to either increase property taxes or development charges, which one do you think you'll choose? You're going to choose development charges, because the people that are yet to buy in your ward are not really influencing your election outcomes. Yeah. The people that are paying property taxes are influencing your election outcomes, right? And as much as I would like to think the world functions in a way where people think about the greater good, they're really just thinking about their ward and their constituents, right? Not so much about who might come into the neighborhood in 5 or 10 years, right? And so I think you have that dynamic. And I've been part of various things. Sometimes the government asks private sector people like myself and others to give opinions and weigh in on things. And I was part of the sort of private sector constituency that the Ford government put in place to, when they did the fair housing, not the fair housing plan, it was the affordability task force back prior to last election. And I had a lot of conversations with people from either actual ministers at the provincial level, or the bureaucracy that works there, right? Like, that help the ministers do their jobs. And one of the things that was a little bit disheartening was just a bit of a lack of understanding of the economics of housing, right? And one of the things that came up a lot was, okay, well, we don't have to touch our piece of it, right? The development charges and the different things like that, because developers can just buy land for cheaper. Like, don't pay as much for land. And I'm like, okay, well, obviously you've never tried to buy land. Like, I mean, if I'm trying to buy a farm from Michael who doesn't need the liquidity and isn't particularly inclined to sell, why would he sell it for 30% or 40% less than his neighbor sold it for a year before, right? Like, it's just not that simple. So it's not as fungible as these people think it is. Or capital, like take less return. Well, it's not Sasha that decides what return is appropriate. It's capital markets, right? Like, if I came to you and said, hey, I have this wonderful opportunity and you're going to put your money in this development deal, and there's political risk and construction risk and market risk and it's illiquid, Good news though, you're going to make 6%. You're going to say, okay, well, I can just go buy a bank stock and hold it and be liquid every minute of the day, every day of the week, and exceed that
Yeah.
return, right? So you have to, there's a compensation for the risk. And so what I'm trying to explain to these people is that the commercial realities of your financing are not fungible, nor is the cost structure, nor is the land, in spite of the fact that you think. And we're seeing this play out, right? Because this is like 3 years ago or 4 years ago. And well, how many land deals have you seen us do, Michael? How many have you done? Not that many, because today's economic realities of what you could sell a home for and all that kind of thing have shifted. So you can't pay $100 a foot for that land. You got to pay $40 a foot for that land. And that's why we bought no land, because those expectations have not shifted on the part of the vendors typically. It may take many, many years before that starts to become a reality and set in. And that doesn't help the government with their housing problem. So sometimes, as you pointed out, there's a lack of understanding that cost at any level is a pass through to the consumer, period. And if you can't wrap your head around that, then, and I've often said to these guys that, because they focus on affordable housing, and it's important to have affordable housing. So I'm not saying it's not important, to be clear. However, if I have a condo building that I'm building and you say 30% of those units have to be affordable units, which today economically are a negative to your pro forma, right? You're actually losing money. It's a cost center on every one of these units. So if 30% of your density is a net negative to your economics, the only way to make it up, given all these other things are not fungible, is that you have to charge more for the other 70%. Right.
Yeah.
So I've often said to them that you guys are fighting for affordable housing at the expense of housing affordability. Right. So
That's
you're
nice. Yeah.
solving for that category, that defined category of affordable housing, but you're just making it less affordable for everybody else. And it's hard to, these things are very complicated when you're also dealing with multiple levels of government, right? You're dealing with, municipal and then provincial, and now the feds are getting involved, right? Like part of Carney's platform, a big part of his platform was housing and what they intend to do about housing. And historically, that's not been something the federal government has been able to have a lot of influence over, because the rubber hits the road at the municipal level, right? Like that's where you're getting your approvals. That's where you need to wait 2 years to get your permits, and all these things that are happening are typically at the municipal level. But now the feds are trying to figure out mechanisms to try to motivate municipalities to either move faster or cut their development charges. And to be honest, like, and we've been in discussions as well with the federal level, and we're planning to, again, before this budget is passed, to try to also engage. To their credit, their heart is definitely in the right place, right? They're trying to be solutions oriented and sitting here, and even an openness to engage with the private sector and saying, okay, here's what we think in a framework. What could be better? How can we make this work? And I'm hopeful. So like, I don't sit here today, as crappy as this market is, in despair, because I do think I think we're lucky to be in an industry that has a lot of demand, as I've said, and I think there's a lot of people looking at the problem trying to solve it. So I'm optimistic that we will.
Yeah, I think that this idea of policy is overlooked. We think about economics as real estate investors, and everyone's looking at, sometimes people are looking in the wrong direction, like interest rates and home values, but really policy, is going to drive a lot of these answers, of this slow grind. And in preparing for our conversation today, Sasha, I went back and I looked at some of the things we talked about on March 11th, because I really enjoy the connection of how we're watching this market progress. And you talked about a lot of these things on March 11th, but you did talk about your frustration with the policy and the city slowdowns, and approvals not matching the urgency of the housing crisis. And I want to just follow up and say, this disconnect between federal urgency and municipal bureaucracy we talked about last time, and you mentioned it again. has it gotten better? Like, it's obviously still a problem, but are we seeing progress where federally, municipally, they're getting tighter? Are we seeing a benefit from a change in government in Canada? And I shouldn't say change in government, just a change in leader within the same party. Like, are we seeing progress? It's not good, but are we seeing some progress since the last time we met?
I think at the federal level, it's too early to say, because the budget isn't being passed until I think it's in the fall. So there's some work to be done. I think based on every indication that I've heard, and I haven't had direct discussions with Carney or his his cabinet, but people who have worked on the policy, I think the intention is strong. So that's a good thing, but it's early. Um,
Okay.
as to your question around has it gotten better even just at the municipal level, and because we've been, notwithstanding the change in federal leadership, like this has been a problem for a while, right? And people have been kind of talking about, man, we gotta solve this problem. And I remember, again, in one of these sessions with private sector, public sector people, I also said something where I said, if you had for those of you who are from Toronto, you'll know what Yonge Street is, but for those who aren't, it's kind of the main arterial road in the city in downtown Toronto. And I made the point of saying, if you had a giant sinkhole in the middle of Yonge Street, um, what would you do? I mean, you'd go immediately and you'd fix the sinkhole, right? You wouldn't have 35 community meetings and have, 100 independent consultants look at it and then drag your feet on applications and studies and, well, whatever, all the like. And then 3 years down the road, you'd fix the sinkhole. You wouldn't do that because Yonge Street is part of your critical infrastructure. Well, it's about time that we think about housing as critical infrastructure, because it is critical infrastructure. So can we cut some of that red tape? And I think the Ford government tries, right? Like they put in a framework that takes out some of the friction, right? And they talk about trying to cut the red tape, but there's actual like policy related things that allow the development community to move developments forward and move different parts of the application forward quicker without interference from municipalities. But at the same time, I think that the problem we're seeing is that, again, it goes back to the political apparatus where there's many competing priorities. I don't even blame the counselors. Like, I can't, this is not meant to say, hey, Mr. Counselor, you're not looking at the problem. The counselor's trying to balance 50 different problems from thousands of constituents who all have differing opinions, and they're doing the best that they can. The unfortunate reality, though, is when you put housing into that political mechanism, it will play out this way, right? Like, and if you took it out somehow, then I think that there would be much more progress. So far, we haven't seen a ton change, but based on the framework I've seen at the federal level, they're using a little bit of a carrot and a stick approach to how they want municipalities to behave, right? Because there's a lot of transfers that happen between kind of the federal government, provincial government, and the municipal governments. And some of those can be based around housing targets and density targets and all these things that they need to do. So I think the federal government has plans to basically say, hey, listen, if you want, and so does the provincial government, if you want X dollars, which you rely on for your budget, then we want Y homes. And we need to get those shovels in the ground. So when they sit down on council, I mean, they're going to need to address that and hopefully speed some of these things up.
Okay. And let's shift from the policy to the investor, and Greybrook. I think we probably all want to know what you guys are up to, because why not follow the best and follow the people that have the experience in making the money. Before we do that, Sasha, we got some requests for you to run for office, but you need to be at all three levels at the same time. Are you any plans to run for government?
Definitely not. Not while I'm gainfully employed. Maybe at some point in a couple decades. I
Yeah,
appreciate
the conflict of interest, maybe.
sentiment. Conflict of interest. The first thing I would do is try to advance all of our development projects. Would that be bad?
Yeah, yeah. Well, I mean, if everyone here got on some sort of government seat and we all just approved each other's projects, but I think I'm saying
I think
something
we'd
that's
all
not
win. I
actually
think we'd
legal,
all
but
we'd all win to some degree, but
yeah.
just a real quick tangent. But if you guys remember, if you're from Ontario or if you tracked what was happening in Ontario last year, the Ford government got in a lot of crap because they took land out of the green belt and they put it into development territory and they swapped land that
Mm-hmm.
was, in development territory and put it in the green belt.
I was just going to
There were
comment.
some
It's not
winners.
like that's never happened, right?
No, for sure. But the thing is it's not like there were winners and losers in that equation. Okay. The people who would have got a windfall are the people who had all of a sudden, their worthless greenbelt land put into development territory and vice versa. And I think you saw what happened, right? Like it was like a massive scandal and everybody got up in arms and checking emails and who went to whose, stag and all this kind of stuff, right? And I looked at it differently, and we had nothing. We didn't have any horse in the race, right? Like we didn't have any windfall or anything else. But like looking at it, understanding the industry, if you're the Ford government and all you care about is building homes, you don't care who makes money. That's not your problem. You are there to deliver on your promise of 1.5 million homes in 10 years, which is a lofty target, but put that aside for a sec. And then what he did was he took a practical approach to this on two levels. He said, well, here's land that's sitting in a green belt that's close to infrastructure that will be cheaper and faster to get homes to market, right? Because of its proximity to pipes and other,
Mm-hmm.
types of things, roads and infrastructure, but it's green belt. And then I got this thing over here that's maybe technically developable, but it's like 2 decades away from infrastructure. So I'm just going to swap these things because I can move quicker. And so I thought that was practical. It happened that some of that land was in the hands of developers. Why? Because developers, when they buy things, they look at it from the perspective of policy, but also what's happening next. Is it more likely that the thing that's really close to the pipes and really close to the roads and sewers and really close to all these things is going to be developed, or is the thing 20 years away? So obviously the first one. So they'll buy that. So the way it looked to the outsider was, hey, all you did was give these developers a windfall. The way I looked at it was like, well, if your job is to deliver 1.5 million homes in the near term, you have no choice but to take that closer, simpler property that's already in the hands of somebody that has the capital, the infrastructure, and the capability to actually deliver those homes, right? So
Mm-hmm.
like it'd be great to give Farmer Ted that opportunity, but if he doesn't have a development company with 250 people and $500 million, then you're not going to get any homes. Right. And I think people ignored that. So to go back to the political apparatus, nobody wanted to have that discussion. It was just, oh, crony and, this and that and the other. And then they reversed it all and they had to retreat. And then how many homes do we have? Not 1.5 million. Not even close. Anyway,
Yeah,
I'm
it's a great example that maybe not everyone remembers or knows about, depending on where you are on the continent. But I mean, it's a great example of a political move that has some nuances underneath the headlines. I guess I can say the way Sasha explains it, knowing it very clearly. Let's talk about Greybrook, Sasha. And
yeah.
some of you are Greybrook investors. Put a little hell yeah or yes in the chat if you're a Greybrook investor or have been in the past. Um, and if you're not a Greybrook investor, you can talk to someone, Sasha's team. Keyspire at greybrook.com is the email address. If you email in, someone on his team will talk to you and see if there's any investments that are suitable for you in the future. At least you make that connection. It's always good to have connections in this business. But Sasha, you've always had a great stance in terms of Greybrook's investment thesis and investment strategy. It's like, look, we're investing for the long term, so we don't get spooked by the short term ups and downs, and that's part of the long term strategy. Okay, people might be scared by a 7-year deal, but that actually gives your team time to smooth out the ups and downs. Um, so my question around like Greybrook and what you guys are up to, what can we learn from your amazing team of underwriters and property finders and deal makers? Um, has that investment thesis changed in terms of what you're looking at today for the future? And what types of properties are you bullish on today?
Yeah. So, you know, around here, it's a tale of two cities, in terms of, you know, how we spend our time and sentiment. Um, you know, we operate on Earth just like you and everybody else, and you have to deal with the realities of Earth. And I say that in jest, but sometimes, you know, people look at existing projects and they're like, well, why is this delay happening? Or, you know, what's precipitating this markdown in our returns? And I would say, well, I mean, nobody's buying anything and things are 20% less than they were yesterday. And the world's a little bit on fire in this regard. So we are also subject to those things. So the tale of two cities is we have to deal with that, as I always walk around here saying, brain damage. Like you literally have to deal with a lot of brain damage. You're constantly firefighting and dealing with issues and refinancing loans in tough environments. You know, we have for those that are in the US, you know, we have a portfolio in the US, and for those who track this kind of stuff, real estate lending rates, mortgages, construction loans are primarily driven on something called SOFR, which is kind of it's like LIBOR, okay? But it's really like a derivative of the 10-year yield. Well, with all this tariff stuff going on and everybody worried about inflation potentially from tariffs and the US, you know, the big beautiful bill, and adding $3.5 trillion to the deficit, it's causing long-term bond yields to spike. Well, if you know the 10-year was at 3.5 and now it's at 4.5, that's 100 basis points or 1% more on every construction loan, on every mortgage. And when you're dealing with $350 million buildings, that adds up. So you got to deal with all that brain damage. So we do that. On the other hand, the exciting part about the tale of two cities is that where you are finding opportunities, they're really great, because there's distress in the marketplace, right? And I'm not talking about distress like bankruptcies and things like that. I mean, that's happening. We stay away from those, like that, you know, they're hairy and tough to deal with. But like you're dealing with situations where people can't make those payments or have, you know, limited capital, and then they have to liquidate their asset, and you're getting to buy it at a pretty good price. So we're finding land at really great prices, and you know, to get around to what we're looking at and excited about the most, unfortunately for a lot of investors, it's longer term investment things. And I say unfortunately because most people don't like to be locked into something for 7, 8, 10 years. But if they have the liquidity profile to be able to do that, you're finding generational opportunities, right? And what I mean by that, you know, for example, we just you know, closed something in Markham, or we're about to close something in Markham, Ontario. For those of you who know that where that is, it's a suburb of Toronto, where we're paying an amount of money for the land that might have been what we, you know, a third of what we would have paid 2 years ago. And it's a distressed situation, right? And we're able to kind of come in, buy something we know. We have several other properties on the block, and we know exactly what's happening from a development perspective. And, you know, people can wrap their heads around that. What turned them off a little bit was, oh man, it's a 10-year deal. And my answer to that is like, I totally get it if you don't have the liquidity profile. You shouldn't be doing it, right? But if you have the liquidity profile, then do I want something that I can approve and sell tomorrow? Well, not really. Like if we just talked about the fact that the market's going to take a little while to come back, it's going to, you know, whatever. I'm actually looking to try to make a development margin. So if I'm buying something cheap today and I still got to do a bunch of work, right? It's not approved. I got to go through the process. There's margin to be made. So while I'm waiting for the market to come back, maybe it's a year from now, maybe it's 3 years from now. But while I'm waiting for that, I'm making money actively through the value I'm adding to get this thing to approved and with the infrastructure embedded in it and all that kind of thing. And I know that come 3 or 4 years from now, I'm either going to be able to sell a lot of homes, or I'm going to have a lot of land that I can sell to developers who want to build homes. And either way, I'm probably going to make a pile of money. So again, there's a lot of stuff to deal with. I saw a comment. Have you purchased land in Brantford? Yes, we have. I love Brantford, but that's a different topic. But there's the difficulties that we're dealing with, and you got to deal with them, and that's the job, and this is what we do for our investors. And then, but on the one hand, there's a lot of opportunity. There's a question here about what a liquidity profile is. I realize I don't speak English all the time. What it means is,
LIBOR, yeah, you use LIBOR like it's everyday language. You were
sorry,
comparing it to something
it's
more
the rate. Yeah,
complicated.
it's
That's
the
good.
rate that banks lend to each other, right? So like think about how a bank gets its money. It borrows it from depositors, but it also gets it from the federal government. And that rate that it lends to its, to each other is LIBOR. It stands for London
Yeah,
Interbank something.
yeah. It was
Anyway,
great the
not
way
the
you
point.
said it. Like a man. You're like, oh, there's this complicated thing. It's like LIBOR,
Yeah.
and I caught it. But yeah,
Yeah,
liquidity stuff.
the liquidity. I want to answer the gentleman's question about liquidity profile. What I meant was, if you have a need in your life where you can't have money locked up for 10 years, like you're retiring, you need to use that money, whatever, then you shouldn't ever lock it up for 10 years. If you're
Or
somebody
it's your
who,
only cash, right? Yeah,
yeah,
or if it's your only cash. Yeah.
if you're 35 years old, 40, 50, whatever you're, or if you're 70 and you have $2 million that are available to you in cash or near term, and that's enough to get you through the next 10 years. And this is now savings for after that. All liquidity profile means, do you have enough to be able to live your life over the duration of the investment?
Yeah. Yeah. Great question. I'm thinking about some of the stuff we talked about outside of this conversation, Sasha, that goes along with this of, we're, as business people, as real estate investors, we're playing defense right now. We've got to accept that, right? And in life, you've got to play defense and offense. You can't always be on offense. There's anyone who plays sports is like, there's always a defense component. Sasha's a hockey guy. I'm a football guy. Defense and offense are probably even more prevalent in football, where it's half the game there's a team on defense. And I think that we're all on earth. I like that. I'm going to use that. So we all have to accept that we got to play defense sometimes, and that's just where we're at today. We're playing defense so that we can play offense. We're playing defense to set up the play for offense. And I think that's how I'd love everyone to leave this conversation looking at it with confidence, saying, I can be confident in the future because I know that at some points I have to play defense and some points I have to play offense. And Sasha, you gave me the example in hockey. Like, sometimes we lose games and sometimes we win games. If we won all the time, that would be fun for a bit, but then it would lose its meaning because we know we have to lose. We will lose some, and then when we win some, it becomes pretty sweet. So, whichever these two analogies bring you confidence, I want you to leave with the knowledge that you can play defense sometimes, but let's set you up for offense. And conversations like this, I'm hoping, are setting you up for offense. I want to talk about the 4 C's in terms of what Sasha's saying in our conversation of, if you are playing defense, the way that you get to offense is with what in my mastermind group, we talk about the 4 C's. It starts by being committed. And when you're committed, you need to have courage. And you need to build, once you have courage, you'll build your capabilities. And then after your capabilities, you'll get the confidence. If you don't feel confident right now in investing in real estate or investing in the market, or hell, just walking out in the street because everything is on fire, you need the 3 C's preceding that before you have confidence. You need to be committed. You need to have the courage. You need to build the capabilities, and then the confidence will come. And I tell you that because if you're feeling unconfident, you just have to do things in the right order. Part of what we're doing here today is helping you build different capabilities and different awareness and different knowledge. But I got to tell you, it starts with you being committed, and nobody can come to your house and make you committed to a bigger future or a better life or hard work for something in the future. And Dash, I talked about real estate investing, like working out the other day to my team. And I said, what we do as real estate investors is similar to like what you would do if, say, you got a personal trainer. It's like, all right, you've got to invest a bunch of money up front. You got to do a bunch of work for amount of months or amount of years, and you're going to see a result at some point in the future. Like, that's hard for us to wrap our heads around as human beings. But if the belief in the 4 C's, if you're committed to knowing that I will have that future, whether it's real estate or the body you want or the relationship you want, and you got the courage to actually go and do something, you'll build your capabilities and then you'll get your confidence. And so I want to give you those 4 C's in order to help you have confidence coming out of here. Sasha, I wanted to ask you about, well, you know what? Let's see if anyone has any other questions, because I have some other questions. And Sasha, do you have any questions for me? And does anyone have any questions for Sasha and I? Just put your hand up and let's hop on here. Let's have some fun. This is pretty casual.
Yeah. So I'm happy to take questions. I do have a question for you, and but before I go there, I want to say that I couldn't agree more with what you've said just now. I think that's very powerful. I think, look, everybody's on this call. You're already a member of that group, right? Like what I tell my team, similar to Michael, is you're gonna get better because of this. Like you don't see it in the moment, right? Because you're dealing with hard things and it's hard, right? But you'll look back one day and be like, man, I'm a better executive, I'm a better investor, I'm better at my job because I had to deal with adversity, right? And adversity is what really forges that capability over time. So I agree with what you said. You didn't answer, you asked the hardest question of all time out of the gate, right? And you said, is it are we Japan? Are we grinding, or is this a recovery? And I went on for like 48 minutes on what I thought. Where do you sit on this? Like you kind of said, yeah, I agree, but you've thought a lot about this. So I want to hear not just the answer. I want to hear your process.
Yeah, great question. So I have been thinking about this now for a few months, and it's all stems from the idea that a year ago, when interest rates were dropping, I was thinking like, all right, it's going to be great. Interest rates are going to drop. We're going to get back to what I'm going to call real estate normal, which is home prices go up every year at 2 to 5%, depending what your market you're in. I can rent a property. I can get my 4 ways to win. I can get my 25 to 30% ROI, whether it's a single family home or if it's a development deal. To me, that's my real estate normal that I've lived for 23 out of the 25 years I've been doing this. And then interest rates went down and nothing really changed. And then earlier this year, it's like, okay, well, there's going to be a government change, or at least a shakeup and I'm going to talk about in Canada, the Canadian government, there's going to be a shakeup. In the US, there's a shakeup in the US government. All right, that's going to work. Every time there's a change, it's shown that things get better. And it happened in the US and it happened in Canada, and things didn't really get better. We didn't get back to my new real estate normal. And so and that's where I come up with like confidence is not confirmation. I had confidence because the track record is things would get better every time those things happened, and they haven't. So I have been thinking about this for many months. And Sasha, I think about it more in context of Keyspire and Keyspire coaching and what we do as a company at Keyspire, because my investments are long-term. So, even if it's a 20-year thing, I'm young enough and insulated enough in my portfolio design that I'm not too concerned personally, although I'd like to make more money than less, but I'm not too concerned. But I am concerned over what is it that we teach our clients? How do we show our clients to get the best possible life when they're starting from a different place? And that's the lens I have. And so we've been talking about this as a team, and we've been saying, well, first, before we adjust any of our teachings, before we adjust any of our strategies, we got to know what the heck is going on and where we're at. And that's the lens I'm looking at it. So, I'm talking a little bit, maybe a lot, but it's important to build context as to who cares? Why do I care about this idea? And so I'm playing around with this idea of, real estate, going kind of on the Lehman Brothers, Goldman Sachs idea of 15 years ago, where everyone said that they're too big to fail, and then they did fail. I'm like, well, maybe I'll take the antithesis of my 25-year view of what if real estate is too big to fail. And I'm just poking at like the devil's advocate side of things, so that I'm like looking at, what if that happened? How would we change things at Keyspire? How would we coach people differently? How would we run our events differently? And what strategies ultimately would we be doing for our investors? And so that's what I'm looking at. I'm not at end of job yet. And I've realized now 25 years in, I'll never be at end of job, because we know, Sasha, as soon as we're going to figure it out, it's going to change again because of all the different factors. Yeah. So I believe we're in the slow grind. I think that all the research that I've done and our team has done around, one of the other economies, I saw one economist, Sasha, said there's 4 types of economies: underdeveloped, developed, Argentina, and Japan. Like those are the four economies because Argentina and Japan are so unique. So I don't
Yeah.
think we're in a Japan style situation where we have 25-year stagnation, but I don't have the confidence or confirmation anymore that by September we're going to be great.
Sure.
So
Yeah.
I feel like, exactly like you said, like we're in this grind. We don't know where we are in the grind, but all we can do is set ourselves up. We can play defense and set ourselves up for when the offense is on the field. We're ready. The offense is on the sidelines right now. I'm a football analogy. The offense is on the sidelines. They can't get out there. They are not allowed on the field until it's their turn. So what are they doing? They're talking about plays. They're getting motivated. They're going over. They're watching tape. They're building what? Their capabilities. They're committed. They're not leaving the game. They're committed on the sideline. They got the courage to get back out there, even though they're getting beaten up. They're building their capabilities on the sideline. So when the offense steps on the field, they've got confidence. And to me, that is what I'm working on. I'm working on my capabilities. I'm working on keeping my courage up, keeping my commitment up, staying with groups like everybody here on this call and talking to people like Sasha and my mastermind groups to make sure that when I'm on the field offensively and our members and clients are on the field, they've got the confidence in the strategies. And so I believe we're in the grind. I'm in the confidence maintaining and capability building stage. So when my offense is on the field, we're going to fucking crush it and win the Super Bowl.
Yeah. Listen, that was really well said. Thank you for answering, firstly. I agree with you. And I think it's critical. Like, it's like you weren't apologizing, but thinking like, well, yeah, I'm just being devil's advocate. I mean, that's our entire job, right? You and me, like our job is to think about the worst case scenario and think about what, you can't just like be oblivious to bad stuff and just pretend it can't happen or won't happen. You'll never be prepared to be able to deal with it. So I think it's important. I want to make, and maybe this will make people feel better, maybe it won't, but like when we sell big, like we own apartments and things like that, and when we sell those big things, it's institutional buyers that buy it, right? It's not because they're 2, 3, 400 million bucks, and institutional buyers are largely absent in the market today because as they sit there, they're looking at it and saying, look, like I don't want to call the bottom. I'd rather miss 10% of the upside, right? And this is why even the stock market, when you watch the stock market, right, like it really bottoms, but then when it starts trending up, it breaks through these technical barriers because capital, it's not that they're dumb and they're chasing return. It's that nobody wants to be bold enough to call the bottom. So they just wait. And yeah, I'll miss some of the upside, but at least I won't be wrong because it's hard to dig yourself from out of the hole if you bought something for $1 and then it goes to 70 cents, right? It's way better off. I bought it at $1.08 but now it's $1.20, right? So this is the psychology of investors. So my belief on these big assets is that when the market does bottom and you see a definitive trend upward, okay, capital, there's a lot of liquidity sitting there waiting. And when that capital returns, it's going to push prices higher. That's my sincere belief. I think individual investors are not that different. Okay. So if you think about the constituents who buy housing on an individual level, whether it's a condo, whether it's a single family home, a townhome, you're either an investor, right? Or an end user. And the end user, you're either somebody who's owned something already and now you're going to buy something new, or you're somebody who is a first-time buyer, maybe, right? Well, the first component is everything I just described. Confidence is a big part of it, and the momentum of the market is a big part of it. So right now, an investor is looking at the math, and they're saying, well, my rents are flat, my cost of carry's up, right? Because interest rates are elevated, and I have no growth rate. It's going backwards. Well, that equation doesn't look great. So they're sitting on the sidelines. So that part of the pool is not playing. Then you have the end users. And the ones who own things don't want to sell them now, right? So they're not necessarily keen to be putting their property up for sale and maybe getting $1, maybe getting 93 cents, maybe getting no bids. So they're not buying either, right? So those people maybe aren't totally out because they're still necessity, but they're certainly way fewer in number. So now all you're left with is first-time buyers who are probably the most economically challenged with high interest rates, right? Because they don't have the equity from their home. They don't have big savings. They're usually younger and or new to Canada, and they don't have the ability to access credit at the same level. So these particular conditions, when you break it down like that, it's not a surprise that there's no demand out there, because each individual constituent of the market's being impacted in a very negative way. But that changes, right? So the first guys come back when they start seeing rents stabilize and start going up again, and interest rates going down again, right? Because that rental math looks better. And then all of a sudden you're seeing, 2, 3, 5% growth in housing year to year. And now that equation looks good, right? So now they can forecast their investment and say, oh, I can rely on, 2, 3, 4% growth a year. I hold it for 5 years, and here's my return. They start coming back into the market, right? And then obviously the more transaction volume, the more confidence it is for people who are selling their home to know that they're going to get a price, and they're going to get a good price for their home, so that they can buy something new. So they come back into the market, right? And lower interest rates will bring back the first-time home buyers. So I think there's a lot of actual triggers. I can't sit here today and tell you whether I think it's going to be 12 months or whether I think it's going to be 24 months, but it's certainly not going to be 5 years. I just don't see that. I don't believe that. And it's not out of ignorance. It's just doing math and having lived through kind of similar things before.
Yeah, I like it. Thank you. We'll get to Deanna and Heather, and just to wrap this thought from Sasha and I, let's train our offense so that when they're ready and they're on the field, when they get on the field, they're ready to go. Let's train our offense so that when they're on the field, they're ready to go. You're all here because you have access to our Inner Circle lives. You have access to our monthly masteries, our weekly wins calls. Like, do it. Just do it. Do those things, because that's building the capabilities for your offense, even if you're an offensive one, so that when it's time to get back on the field, you're out there and you're crushing it. And you can identify the things that Sasha just talked about. Deanna, great to see you. We're almost at time, so let's do a couple questions, conversations with Deanna and Heather, and then Sasha. We always end up going way too long. We always end up going, I shouldn't say way too long, because we could chat all day, but we always end up going over. So why don't we do a couple discussions here, and then we'll wrap. Yeah, awesome.
Hey.
Deanna, over to you. How you doing?
Good, thanks. Thank you too. Michael, honestly, like, you're the only one who could get us hyped up for commitment and courage through the grind. Like, we're all now like, yeah, let's grind through this. So a couple
Thank
of
you.
questions, and Sasha, you actually sort of started to cover them in that last little soliloquy there. So I was going to ask first about the US market. And do you think if we get our first rate drop for September, that's actually going to be enough to spur the market? I've been seeing a lot of markets have the same number of listings as back in 2008. For those of us who were investing down there back then, it was a bit of a crazy time, but there were some great opportunities. And then sort of, the follow-up to that, then back to Canada, like, what sort of timing do you think? And I was going to ask, if we're sitting on land right now, we have an offer coming in that's, I wish it was 93 cents. But how long should we be planning to hold that land, do you think? Like, what should our game plan be on that? Love to get your thoughts.
Sure. So let me answer the second question first. I think that, again, it depends on how equipped you are to hold, right? There's people out there that, bought something, they have a big mortgage, they have payments, and you got to do that math, right? Like, so time is money. If you find yourself in a position where you have a bit of breathing room and you have the ability to hold, then I would hold. The question of when, I think land is typically not all that slow to react, which is a good thing. When developers see markets coming back and activity coming back, they have to start buying inventory, right? And land is the first thing in their inventory. And I think there's a lot of developers out there, without even knowing the specifics of your land, there's a lot of developers out there that have inventory that's depleted, right? And they're going to need to get out there, and they want to get their people working again, and all that kind of thing. So I do think demand for land will return sooner rather than later once we see the market shift. So now your question, the first question dovetails into the first question, which is when does that market shift? I think there's a lot more complexity than just interest rate today, you know? And Michael said it, and I'll repeat it, like confidence is such a big part of this. And right now, interest rate is only one component of what gets people comfortable and confident. And I think, you know, obviously what's happening with economics and policy opposite the US, you know, tariffs, no tariffs, you know, people are nervous. They're nervous about what that means for their job. They're nervous about what that means for kind of long-term prospects for Canada. I think that once that's off the table, that will be the biggest catalyst, I believe. My one concern, if I were to share a concern, is that so far there hasn't been a lot of predictability in that, right? South of the border. And I think, you know, President Trump's style is different than most. And I think we can all agree, whether you like him or don't like him, it's not the point. His style is very much shock and awe, right? Like he's trying, you know, he's not afraid to act and then think later. And that causes a low level of predictability, which probably helps him in a negotiation, but certainly hurts the market, right? Because people can't get confident because you think, okay, well, today this is the story, tomorrow it's a different story, and then the day after it's going to be a different story. I think once we button down that actual agreement, like Japan got a deal in principle done yesterday, and there's you know, Canada's kind of working on it. I think once we get more definition and clarity on what that looks like, and I do believe we're going to come up to some agreement that's slightly worse maybe than it used to be, but not a catastrophe by any stretch. I think that plus an interest rate cut, we'll start seeing some confidence come back into the market. That's my prediction.
Great. Thank you. From your lips to God's ears, my friend. Thanks so much.
You're welcome.
Yeah, thanks, Sasha. Heather, great to see you.
Hi, guys. Thank you so much. This has been amazing conversation. I wish it could go on forever, but it can't. So my question for both of you is, with the push for needing new housing as individual investors, like most of us on this call are building our portfolios, what would both of you recommend would be the best investment now when we're keeping in mind that we, as a country, we need to build more housing and we're building our portfolios? So for example, like, is it sixplexes or apartment buildings, or what would your guys' recommendation be for the individual investor building their portfolio?
Sasha, you go first and then I'll answer and then wrap the show for us with the turnover to Jason and Richard.
Yeah, I'll try to be brief. If you are looking to invest your money actively, I'm going to make that assumption. Meaning like it's not just, hey, Sasha, here's some capital and go do what you're going to do. I think that what I like out there is there's a lot of defaults happening in places like Toronto, right? People that bought condo units, they can't close, you know, they're not getting the appraisal they need, whatever the case may be. And a lot of times that's repricing those units, right? So like ultimately you're getting to pick them up at sometimes 20 or 30% below what they traded for 3 or 4 years ago. We as an institution have looked at that strategy and looked at the math, and we think the risk reward on it's exceptional. Like we think you can make money doing that, right? You can buy this thing for 30% less, put a tenant in it, you can be kind of cash flow neutral. And then you're going to probably see some upside because for sure the market will rebound at some point. We haven't acted on it as an institution because for us to aggregate hundreds of units, like we need scale, right? So like the ability to be able to go do 200-300 of these and then liquidate 200-300 of these at some point, almost impossible. But at an individual level, I think there's a really, really timely sort of unique opportunity. So that would be my favorite out there. And then, you know, I always talk about land, buying land, because I always love buying land, but that's a tough business if you don't, I wouldn't recommend it if you didn't have a lot of planning expertise to be able to do that. So I would say the first one would be my choice today.
Love it. Thank you, Sasha. So I'm going to try and give you my answer pretty quickly because the coaches and I have been talking about this for months now. The question, I'll rephrase it, is what's the best investment right now for a individual real estate investor, right? You are not encumbered by scale like my mutual fund trust or, Sasha and Greybrook, like we've got to find things at scale so our investors get paid. But you're not encumbered by scale. So your options are open, a lot more open, whether you know it or not. I'll say a couple things to preface. Number one, I think is one of the best buying times because the people have problems. I mean, look, we're real estate investors. We're in business. When you're in business, you have one objective is to solve people's problems. And so when things are bad, people have more problems than when things are good. And related to what we're doing, real estate investing, people have problems with selling their home, with affording their home, with all of these different problems. So the buying opportunities now are the greatest that they've been since probably 2010, 2011. However, something really interesting I've noticed, Sasha and Heather and everyone, is that when the buying opportunities are great, there's usually like a large margin of error. Like it's hard to mess it up. Like you're getting things under value. I remember getting things pennies on the dollar back in the day, 2011, 2012. And if you get something for 30,000 or 20,000 under value, you're still happy. You're still doing good and people are renting it. Margin for error was large because of the opportunity. It's interesting now because what we're seeing is the buying opportunity is there, but the margin for error is much smaller. Like it's a lot easier to make a mistake just because transactions, a lot of things that we've talked about. So you really have to be tight and educated on your system and on your process. And so right now, process and system is king when it comes to buying that property. So that's what I'll say before I tell you what I think the best thing to do is. But you got to be tight on process. And so for Keyspire, for us, what this means is 4 ways to win every single time. Run your 4 ways to win before you buy a property. Know what that return is. Always make sure that you're cash flowing today in buying a property. I mean, always. I've had cash flow conversations many times. You should always have cash flow when you buy a property in our individual investor business. And always do your income analyzer. Those of you that haven't been trained on the income analyzer, anyone in the mastermind group, we trained you on doing the income analyzer. It's very simple. It's a tool and a process we have at Keyspire. I call it one of our 5 core tools. If I only teach people 5 things, the income analyzer is one of them. It allows us to test the rental market before we ever buy a property. We post phantom ads. We measure the response. We have a script we follow. We answer, we measure, we put it in a sheet, and then we come up with a quantitative way to assess what the rental revenue will be on the property. So you got to get down to basics before you buy anything. You got to use your Keyspire tools, and the process in the system has to be tight right now because the margin for error is low. If you're tight on the process and the system, then there's a lot of opportunity out there. So what is the opportunity? For me, if it were me, I would, if I were advising a Keyspire client or my sister or a family member or anybody that I care about, it would be find properties that fall within the 4 ways to win. Those properties right now are generally back to basics. Single family homes that you can put in an income suite. Single family homes that you can put in an income suite and maybe an ADU, an accessory dwelling unit. They have different names in different parts of the countries, but an accessory dwelling unit. You're finding ways to have one property and to make more money off of one property because that solves one of the number one problems we have. I'm just going to say in Canada now, US is harder to generalize because it's so much more diverse throughout the US. So I don't want to generalize, but in Canada, people need a place to live. And if they don't want to live in a condo downtown Toronto or downtown in a city, they're going to live in a single family home in a suburb, and they might live in an income suite and they're okay with that, or an ADU. So for our coaching program, this is what we're building around now, is getting back to basics, getting that income property. When Scott and I started income property, it was in the same boat as the world is in today. And we started the income property based on our business, the show based on our business, because people wanted to have more money. They wanted the income properties. Today, it's almost like people need the income properties. They don't want them anymore. You need them. So that'd be number one. The second, and a little bit more aggressive. So you got to make sure you are personally qualified for this and your system personally allows you. But buying a piece of property and building, say, a 6-plex. And I'm going to just speak to Canada now because there's an MLI Select program. There's some CHC programs that really helps us as investors with these smaller 6 to 8 plexes. There's these GST and HST rebates programs that can apply in certain situations. So if you've done a few of those single family homes and you want to try and build something small that you can rent, not that you can sell. Don't build something to sell, build something you can rent to keep it forever and make your 15, 20%, make your small cash flow, but make it forever. I remember the story of when Scott was pitching income property to the producers, and flipping properties were all the rage back then. And everyone loved flipping properties, the shows, the TV shows. Like you buy a property and you make 100 grand, 200 grand on the flip. So he pitched the show as we buy a property, we do the income suite. And the producer said, let me get this straight. You buy a property, you do all this work, you put strangers in your basement and you make $300 a month. He's like, yeah, I guess if you say it that way, it doesn't sound very sexy, but it works. And when we filmed the pilot for income property, they're like, okay, this show's not going to work. It's going to, we'll try it. And Scott May funded a lot of that pilot. And the audience, the market loved it because it was so real. It was back to basics. There wasn't hundreds of thousands of dollars to be made in 30 days. It was build something that stands the test of time, that can stand for 10 years as we get through this grind. And so, without getting into further strategic details, that's what I would say. Great buying opportunity. Systems and processes have to be tight right now, and get back to basics with income properties that work with the 4 ways to win. Is that helpful, Heather?
Thank you so much. That is brilliant. I appreciate
Thank
you
you.
guys, all your sharing all your brain power
Thank you.
with us. Thank you.
Thank you, Heather. Thank you. And I'm going to thank Sasha. Sasha, we'll hang out again and chat outside of this, but thank you for being here. We'll make a note to invite you back on maybe in October, November. So would you guys like that if we had Sasha and I did this again and we hijacked Inner Circle Live from Richard and Jason in maybe 4 or 5 months or so? Yeah, and seeing some claps. Awesome, man. Well, thanks for being here. Always great to hear from you and the way you break things down. Even though that sometimes you use words we don't understand, we still get what you're saying. You have this great talent of doing it, and it's absolutely amazing.
Yeah, I gotta get better at LIBOR. So next time.
Awesome.